All right, what's up, everybody? I am currently in the middle of an airport, which explains the look. Wanted to get a quick video up about the inflation, the record-breaking inflation report that we got today. If you haven't seen already, the consumer price index was up 6.2% from a year ago, and I apologize for the audio here. If it is hard to hear me, I apologize for that in advance. That's the highest spike in inflation since 1990. And then if you just look at core inflation, which is their typical trick, they like to look at core inflation, which is taking away food and energy, because that's usually going to show a lot of inflation. It increased 4.6%. That is the fastest gain since 1991. And so this time, they can't blame it on one single category. In the past couple of months, you've seen them try and blame it on, oh, it was just used cars, or oh, it was just food, or this time it's everything. It's energy, it's cars, it's food, it's shelter, it's everything. And it's important to remember, because we're about to start to see the narrative shift, I believe. The narrative so far has been that inflation is transitory, caused by supply chain issues. And it's important to remember that inflation, the money printing, spikes demand. This demand then causes the inflation and causes shortages. They're going to start blaming the inflation on the shortages. I mean, they already have, but that's going to start to turn. The transitory narrative is slowly starting to disappear. They're going to start blaming it purely on supply chain. They're going to say, hey, we need to spend more on supply chain stuff in order to fix our infrastructure, because this is causing the inflation, when in reality it's the money printing that has been doing it. And it's only a matter of time before bond funds, hedge funds, traders start to really figure out what's going on here. They start to believe the reality that it's not going to be transitory here. They're going to start selling treasuries, because treasuries are yielding lower than inflation. Significantly so. And so that means when everybody starts selling, bond prices go down, yields go up. And if yields go up, this would have been talking about for a long time. And they're going to start to rise in compensation for that inflation. Nobody's going to hold something with a guaranteed loss. They've only been holding it so far because they expected the inflation to be transitory. You can debate how smart they are with that view, but that's been the prevailing narrative. And I'm not talking about short-term rates going up, because the Fed controls those. I'm talking about the longer-term rates that the Fed doesn't exert explicit control over. This is what I've been talking about is going to trigger the next crash, the next stock market crash. And then the Fed's going to have to reverse course to stop the deflationary death spiral from occurring. So they're going to start buying bonds like crazy. That's going to be the number one thing they're going to step in and do, and just start, like we've never seen before, buying bonds. So this is where we talk about natural price versus market price. And I apologize, I'm not used to wearing a mask, and so it sounds muffled here. So again, I apologize for the sound here, making do with what I have. So because the Fed is going to need to step in and stop the price from dropping, that means that's going to stop the yields from going up, because prices and interest rates are inversely correlated. So this is the difference between fair value and market value. Fair value is like what it should be absent intervention. Market value is what the price actually is right now. And so they're going to have to put a floor underneath the bond price by buying as many bonds as needed in order to keep the price up. But the problem is, this doesn't change what the fair value is. That just changes what the market price is, which incentivizes everyone to sell more. Imagine Apple right now. If they announced they were going to buy all old used iPhones for $2,000. Well, an iPhone 6, an iPhone 5, whatever it is, probably not worth anything. iPhone 7 or 8 might be worth a couple $100s. And so everybody would sell them as fast as they can, because they know that the current market price, which is all Apple, is much higher than the fair value. It's much higher than what the price should be. So it incentivizes selling. And it's not like this is like a theory. This has happened before. One of the most famous examples is John Law and his Mississippi bubble. John Law controlled the central bank in France 300 years ago. He printed money in order to buy shares of his company, the Mississippi Company, and that was to keep the share price elevated above the natural price, to keep the market price above the natural price. And it was because the shares were what backed up his currency. Richard Cantillon was one of the people who realized what was going on, and he sold it all, used the proceeds to buy gold and silver, got rich from it, and he's where we get the Cantillon effect from. And so turns out inflation wasn't transitory. They were wrong about that. It's sticky, and it's still not even slowing down. Every month, new record broken. And so that's just if you go by the official numbers. And if you look at the private estimates that look by city, look at a more reasonable basket of goods, they don't do some of the tricks like the replacement method, then your private estimates are showing that it's closer to 15 or 20% depending on the city that you live in and your lifestyle, the inflation rate that you're experiencing right now. So, and central banks caught on to this, a few years ago. Central banks started selling treasuries, and now the Federal Reserve owns more treasuries than all central banks combined, all other central banks combined. And that didn't used to be the case. And it's only a matter of time before institutions and funds and traders start to figure out bonds are a guarantee, they're just a guarantee of a loss. And they start selling, sorry about this, they start selling because they're just, guaranteed a loss. Why would you hold something that is guaranteeing you a loss? And if the world doesn't want treasuries, and treasuries are just dollars that pay you an interest rate. If you don't want treasuries, you definitely don't want dollars that don't pay you an interest rate. And so they're going to end up sending them all back to the only country that still accepts dollars for payment by law, which is going to be us, the United States. And all the inflation, all that money we've printed and exported overseas for decades comes rushing back home. So that is what I'm seeing going on here, and that's what I'm looking at happening over the coming months, coming years. And then just a heads up, I'm going to be in Miami for a week. This weekend I'll be at the Market Disruptors Live conference. I think there's still time to sign up if you want to make last minute plans. I'll link it in the description below. So my upload schedule will be a little bit irregular. I've got a couple videos I recorded in advance that are coming out for you guys. So for those of you who will be there, can't wait to see you in person. And as always, thanks so much for watching. Have a great day.